Hello and welcome to another video of thetraderguy.com, and the video that I'm uploading today is about the reaction to the non-farm payroll announcement of a flat, neither positive nor negative, employment number coming out of the United States on September 2nd. Um, while the reaction was decidedly bearish, there are technical reasons why it may not be the end of the world. The first thing we need to look at is the fact that the markets have been exceedingly resilient. Even though there has been some pullbacks here recently, it seems that over the last year and a half or so, and when I say the markets, I'm also referring to stock markets as well, that in the face of bad news, they react with a little bit of a knee-jerk reaction, and then they defy all logic. The fact that there was a flat employment number come out probably, truthfully, surprises very few people. And the fact that it wasn't negative still gives some hope, albeit, you know, somewhat foolish hope that things aren't as bad as people are starting to suggest. But the reality is when you look at charts, there are reasons why things happen. So, for example, at this number right here, which happens to be 140 on the euro, it's not magic that there's a line there that makes prices move back and forth. What it is there are fundamental traders, large traders, who believe that at 140 the euro is undervalued for whatever reason. Technical analysis is simply looking at support and resistance, which is simply looking at where there is more demand than supply or vice versa. There is a lot of demand for the euro at 140. Now, having said that, we do see that the highs had been getting lower, but it appears at this point in time the euro seems to be a little bit just kind of stuck between 140 and 145, and it appears that that may be the case for a while. Eventually it'll break out, obviously. But even with the wicked bar or candle for the week that did close very bearish, you can see that we are still well within this range. And as such, maybe it isn't quite the end of the world as we know it, so to speak. When you look at some of the other currencies against the dollar, and remember, even though there's a poor jobs report, they will buy the dollar for safe haven. Basically, it's really not buying the dollar. What it is they're buying treasuries. Um, and we did dip to, I think, 2.03% on the 10-year at one point on Friday, which is pretty low. Um, but you can see, like the Kiwi dollar, you have a shooting star right at 85. Very bearish signal, except you see this very supportive hammer. So what this suggests isn't necessarily a breakdown of the Kiwi dollar. It suggests that we are going to possibly go back into consolidation between 80 and 85. Again, not the end of the world. Looking at the Aussie, somewhat similar in the sense that we have a shooting star, we have a massive hammer. Looks like we may want to consolidate in a fairly tight range. We're going to 105 is like a magnet, and quite frankly, if this pair were to fall, it would have to break down below parity for me to be comfortable to short it on a close, on a weekly, or even maybe a daily close. Until it does that, I believe that this massive support area should hold. So even in a worst case scenario, it looks like we're going back in between the parity and 105 consolidation areas. Truthfully, even that might be questionable. Looking at the pound against the US dollar, you can see that yes, it fell against the US dollar, but we are between the 160 and 165-ish areas, much like we are in the euro. But on top of that, we also have several levels where we can find support and resistance, and that's basically where we're at. So having said that, again, even though we've had a negative week, it really doesn't seem to have moved out of the standard deviations over the last couple months. It appears that we are still stuck in a range in this, and all of these charts tell me the same thing. They tell me that um, perhaps we're not going to be bullish, but there is limited room on the negative side as well, as far as the risk on, risk off type trade. And because of that, it looks like the reaction, although fairly strong, and another perfect example would be the dollar CAD. You can see that we had this. This is the daily chart. We had a very bullish, and there was a hammer there, and it's a perfect place to see a hammer and everything. But if you look at the daily chart of the CAD, you can see this is another example that it appears that we aren't necessarily going anywhere. We're just going back into the recent consolidation area. And if that's the case, then it makes it look like very little's changed. Again, looking at the CAD on the weekly, you can see that we have this massive shooting star at parity, and until we break above parity, really what have we proven? We haven't proven anything. We just proved a return to the consolidation. So while many people are probably piling into the dollar this up for this upcoming week, we may or may not get dollar strength. It looks like we might, but only in a consolidative sense, only to a certain amount. And this video right here has been based upon looking at the bigger picture before you're getting involved in some of these knee-jerk reactions. It's very possible that we come out, uh, early in the week and it's a little bit dollar positive, and then sometime in the middle of the week we turn around and reverse things just simply because we're at the other side of the consolidation. So don't be surprised if that happens. Um, too many traders will go into this looking at the very ultra short term, and they don't realize that looking at the big picture is really what's going to guide you. The short term isn't as important, and in fact, you could be a little messy if you go with the long term as far as entries and exits. It's a lot more forgiving than trying to precisely pick off 26 pips or whatever. And this is a perfect example of that although these all look dollar positive, they're only somewhat dollar positive. There's only some room to move. I mean, in the dollar CAD, you're looking at 160 pips at the most, more than likely. If parity gives way, that's a whole different story, but you have to think parity is a big, big, big area. So, just like the other charts, maybe dollar positive, but just for the short term. More than likely, we really haven't proven anything, and we will continue to kind of muddle around in the currency markets. So, if you guys have any questions, feel free to email me at chris@thetraderguy.com. And until next time, I'll see you out there.